Hello and welcome to Trading the Trend. My name is James Boyd. We welcome you here today. Have Michael Fairborn in the chat. We welcome him and happy Halloween to you. Jax is waiting to put on his costume patiently. I said, if you're a good boy in the next 45 minutes, I'll put your costume on early. Jax is my dog, and we could say that maybe he is the Schwab pet mascot, perhaps. A little fun there, okay? Take that joke. Now, just remember, as we get started here, options carry a high level of risk, not suitable for all investors. Not all of our examples are going to be options. Some of them are going to be stocks, and we'll point out what strategies we're picking and why we're considering those. Now, when we bring up an option example, that doesn't mean you can't learn anything. And you might have some questions as you go. So if you see Mike Fairborn answering those questions, and I'll also be looking at those questions as well, just know we'll try to help you out as we go. Remember, the information here is provided for general informational purposes only. Today we have some great content. Okay, I'm going to try to do some, do a good job presenting that material. But we've got a lot of earnings examples we want to discuss, and also current examples and market posture. As we go, you might have some questions. Do not be shy, okay? So just go ahead and ask the question. Also remember that Schwab does not recommend the use of technical analysis. It's a sole means of research. We will use a paper money software application known as the desktop version, and also investing involves risk, including loss of principal. If you're not sure on that, just look at SMCI for the week. That will verify that. Now, remember, short options can be assigned at any time prior to the expiration, regardless of the in-the-money amount. And also remember the understanding of option Greeks and how they measure a sensitivity, okay? And we'll talk more about that here today. So we'll take a quick look at where the market and sectors are. We'll also talk about past earnings examples. We're going to talk about current stock positions and stop adjustments and exits, potentially, and also some new examples, okay? So we got a lot to cover here. So let's just kind of buckle in. So first off, when we take a look at the market, and one of the things we don't like immediately, okay, it's never a good sign when we see the VIX in trend 3, okay? So when we look at that chart, that's going to tell us the price is above both moving averages. You get the VIX up, okay? Now remember, we got election day next Tuesday, so it's kind of not a surprise, okay? People's personal volatility probably eating them alive, okay? And so what you're going to notice is volatility up, and what you see on the SPX, the NDX, the RUT, and the Dow Jones, trend 1 for all of them. So that's priced below the 10, 30 period moving averages. So when you see this, okay, this kind of really goes back to why in, let's say, the last little bit, when we start talking about trends starting to crack, okay, what an investor might use to protect last week, okay? Less feeling and more discipline, okay? So this is where when things start to go down, we want to kind of have a plan ahead of time, and we're going to follow through on that here today. Now, when we take a look at these charts of what they look like, the S&P, we had been in an upward channel, and then really about the last, let's say, week or so, we never regained that channel, and it kind of just went sideways at best. Now, the thing that's just rude, okay, is that 20 period moving average has been on fire, okay? Now, you take a look at this, that 20 period moving average can't turn green. You know that trend's maybe starting to sour a little bit. The 10 period moving average went up for a day, and you're going to see that really wheels fell off the wagon here today as we gap down. And we'll talk about those two trades that actually kind of got hurt a little bit, or did they? Okay. And what you're going to notice is we're kind of right back down into this area of consolidation. So the shorter term consolidation up top, higher than 57.90 to maybe 58.60, 58.60, it didn't hold. Does that mean it can't be neutral still? It's neutral at best to short-term down. Now, NASDAQ, briefly, you're going to see, and I'm surprised it's not even down more than this. NASDAQ, we'd probably still say it's neutral, okay? But this had been the strongest one, but with the semiconductor abysmal performance this week, it just finally kind of gave out, okay? So what does this probably mean? A lot of stop adjustments, maybe potentially exiting. We'll talk about that. And also protection. Okay. Now, I'm not really sure if we would say bearish trades, because if you do bearish trades, it might be for an event. You might do other things to maybe try to neutralize your delta. Okay. Now, when you look at, let's say, the rut, man, just smack dab right in the middle. That's why I'm kind of saying be careful, okay, and thinking everything is bearish, okay? Now, I'm not saying that some stocks don't have a trend of bearish, but when you look at the indexes, they kind of look a little bit more sideways. Let's get a quick look at what the VIX looks like. Here's the VIX zoomed in, and there's your little push to the upside. Always hate it, okay, when the moving averages and we get that green shade on the VIX. Usually kind of means, hey, there could be a shorter term pullback perhaps. Doesn't mean intermediate or long term, but you kind of hate that a little bit. Now, the problem is you don't know where the high is. You know that, for example, if those short-term moving average goes green, the 10 there, and the 20-period moving average, those go green, that goes green as well. You got volatility expanding. Volatility expands or goes up. Prices on a majority basis tend to go down. Now, I won't go into sectors. You got utilities, okay. Real estate, okay. Financials, okay. Industrials got pushed down. Discretionary is okay, but obviously tech got pushed down. This is kind of like what we said to start the week. Not a lot of great sectors, okay? And this is kind of matching more neutral performance here on the indexes, okay? Now, on Monday, we did a lot of earnings examples, okay? And let's bring these up. So I want to kind of show you these. And so first off, a lot of times when people do examples, they do like, I did one trade. I mean, look, that's probably not realistic. One trade, that's it. We want to get a couple trades up and really kind of get a gist of how the strategy works. So our thinking behind kind of doing a lot of these earnings trades was maybe the market's going to be neutral. Maybe let's try to use the implied volatility and maybe look and see if it can drop. Okay. So what I'm going to do is I want to kind of start with the one that we ended up with the other day on Tuesday. Now, Ford, okay, now I want to kind of test your knowledge a little bit. These were all done on Monday the 28th or the 29th, okay? Now, we did probably the majority of them on the 28th. So on Ford, you're going to see that we sold 10 contracts. We have 15 days left. Sold it for 47 cents. It's at 90 cents. So if you sell for 47 cents and it's at 90 cents, you're upside down 43 cents. You got 10 contracts. You're down 430. Someone tell me what the break even is. Okay. Well, break even, $11 minus 47 cents. And we're talking about break even when? Today? No. Break even at expiration. What's the break even? Well, that break even at expiration in 15 days is really going to be 11 minus 47, and that's going to give us a break even of 10.53. Okay? Now, where's the stock right now? It's at 10.28. So how much do I need this stock to go up by expiration to pretty much break even? Pre-commission. I just need a quarter. Just give me a quarter. Come on. Okay, now, so overall, in that time decay, sitting here about 12, trying to get a little erosion there. So we talked about that on Tuesday, okay? No real change in the P&L. Stock went down almost 10%, and the position on keyword 10 contracts is down $430. Now, you got to remember the delta on that $712, okay? So if we're sitting on a $430 loss and the delta, let's say, is 714-ish, well, how much do we need the stock to go up to like work off that loss? We need about, check me on that, we need about a 60-cent up move today or sooner than later to work off that loss. So no real like panicking on Ford, but it is down, okay? So no change there, got 15 days left. Now, some of these others won't have that. Google, tell me what to do on the position. Okay, now Google was actually done. Let's kind of verify on this. Google was on the 28th. Okay, check me on that. That should have been Monday. And what you're now going to notice is the option that we sold was 365. That option now, because remember, when you sell it, it doesn't stop trading. It continues to trade. And that continuing to trade is affected by time, price movement, and volatility. Well, if we look and see where it's at now, it's at 7 cents. So tell me what to do, okay? Now, I want to kind of point something out that someone said to me. You know, hey, let's say the investor says, hypothetically, I have SMCI, I sold the put, the investor says, and I got killed. Well, this is why the investor might consider now buying the put out of the money. It's unlikely that it's going to be worth something, but just to have downside protection might be helpful, okay? So I don't think a lot of times when you have learning lessons like that, if that were to happen, it doesn't take but one or two of those to remind yourself going forward. That investor might say, I'm always going to have an out-of-the-money put just in case. I don't plan that it's going to be worth anything, but if that stock goes down like SMCI, at least there's a defined risk to it. Now, could we try to go out there and try to sell that 145? Well, you could try. It's just there's not that much there. Now, why did you keep these on? Why don't you get out of these when maybe there might have been a higher potential gain? I want to involve you in the process, okay? Now, we could try to buy this back for nickel or less and be commission less. What we're going to do in this case is we're going to try to grab, we're going to right click. We sold it initially, okay? And so we have -1, we're trying to get back to 0. So if I have -1 and I buy one, we're going to get back to 0. 0 represents we do not have the position. Now, you might have already done this. And what I'm going to do is I'm going to go to about 9 cents here. And what we're going to do is confirm and send. Now, notice we're giving back 9 cents of the initial credit and the 65 cents. Now, you might have said, James, I bought mine back for a nickel, okay? And it was commissionless. Now, you might kind of be wondering, well, where can I see the price movement of these? It's a good question, okay, if you have that. If you go to the option that you have, it's as simple as this, okay? Right-click on the bid or ask of the option that you have. Right-click. What we're going to do is we're going to go down to where it says More Info, and we're going to chart, not the stock, we're going to chart the option price. What we want to know is how low did it go? More info, toss charts, and I'm going to put it right in that first box there. Now, what does this do? Well, so if we take a look at this, let me bring that up. We're going to right click, more info, and we're going to go to toss chart. There it is. So how low did it go? Okay, answer to the question. Well, it shows on the chart it went down to a penny. So is it maybe possible? So this right here, it's charting the weekly 162.5 put. And it's saying that it went down to a penny. Okay, so it might have been a chance to buy it back for less. Okay, you have to double check the bid-ask spread, things like that. How do we do that again? Pretty simple. Go to the option you have. Okay, so not too bad. Right click on that bid or ask. Okay, there it is. Go down to more info and go to charts and then just tell it where you want to put it. Okay, now there it is. And it's going to chart the option price over time. So on that one, what we're going to do is going to buy it back, confirm send, note the commission, check, and send. Now, what you're now going to see is we're trying to buy that back. Now, here's the thing. Do not assume anything. You always verify. We want to make sure that this has a big donut or 0 for the short option. Why are we so fanatical about that? Well, we're fanatical about that because this option only has 1 day remaining, okay? So this is where you can get assigned the shares of the stock. Assigned means we buy the shares, someone sells us the shares of the stock, okay? And we are the buyer at the short strike, okay? So notice we don't have that. That position right there, most likely to go worthless. If you said, James, I'd sleep better at night not having that, the investor could try to get out of that position. We're going to leave it on. Now, I want to go to Meta real quick. Now, Meta, this is a great learning lesson. Okay. Now, Meta, we know that, for example, we had 2 short options. Okay. 2 of them. And those options were sold on the 29th. It was Tuesday. And those options were sold for $11.45. Okay. Now, I want to kind of go back to something just really quick. We're going to go to Analyze. And what we're going to do is going to go Think Back. Okay. So we're going to try to kind of just go back a little bit. I want to see what this, go back and see what this looked like. Okay. And I just want to see, like, what did that option table look like at the close on Tuesday? Well, so here we are. We're on the Analyze tab and we're on Think Back. And this is looking at the close on Tuesday. Now, what do we want to see? Well, we're going to look at the November expiration with 3 days left. Why are you looking at those? Because those are the ones we have. And you're going to look and see the implied volatility is at 115. Where do you think the implied volatility is today? Well, if I wanted to see where it is today, we're going to go right to the Trade tab. Okay? So when we look at the Analyze Think Back, it's looking at the close. Okay? Now, I'm going to pull up the trade. Now, remember 115. 115, 115, 115. Let's go see where it is now. The November expiration is all the way at 42. So let me ask you something. How is it possible? So this was at 115, and it dumped all the way down to 42, and the stock, and apologize, it didn't take it. So let me go back and actually see what that is. Meta, what is it? So we were a little off. Meta, it's at 46. So it went from 115 to 46. Now, I'm just scratching my head a little bit because you're thinking like, well, it went down $22. But you got to remember, $22 on a $568 stock, it's 3-4%. It sounds huge, $22. You got to kind of say, well, what percent is that? Okay. Now, how did the trade make money? Can anyone explain to me, how did the trade make money? Even though the stock went down, how did the trade make money? Or how does it have an unrealized gain? If we look and kind of see where this was when we did it, it was there. And the stock is lower than where when we put it on. Did we benefit from direction? No, we were wrong the direction. Now remember, you get the direction right, you have time go by, which if you're a seller, you might be able to capture that. And the third thing is the volatility. So the way this trade really gained is the volatility dropping. Now, here's the other point. Stock goes down $22, and what you're going to see is the volatility went down a lot. How many times do we see this? Now, here's the question I have for you. Even if we went down, here's what I want you to think about or try to find. Find me a stock that went down on earnings and the volatility went up more than 5%. You're going to be looking for a while. Okay. Now, so I want you to, that's a challenge. Go out there. Stock actually had earnings. The stock dropped, okay, and the volatility went up 5%. Just try to find one. Okay, it's a needle in a haystack, okay? So it's interesting, just because it drops, it doesn't mean the volatility stays flat or goes up. The volatility, that air came out of the bag, so to say, okay? Now, what are we going to do on the position? What are we going to do on the position? Well, you have 1 day to expiration, okay? So now what you're going to notice is, now we did 2 contracts. It's up $142, okay? And if we look at this and kind of say, well, James, how low did that go? Could we have maybe had a bigger gain? Oh, where could we go to find out? Was the price lower than 212? Well, let's pull it up and find out, okay? So if I pull up Meta, how are we going to do it? Well, just like we did before, we're going to find out the short position. This is the one we have. We're going to right-click on the bid, and we're just questioning, like, how much of that option premium did we have? Okay, bring it up on the chart again. There it is. Oh, my gosh. So what you're going to notice is the option is showing that it went down to 74 cents. What's my point? Well, if someone did this and they weren't teaching a class trying to explain it to people, they might have said, James, I had a potential bigger gain. Okay? Now, we're doing it in class so we can follow along and kind of walk through that education. What you're now going to see is this gain could have even been bigger. Instead of having 42%, it probably was over 50%. Okay? And that obviously dollar amount would have been bigger. Now, if the investor says, look, I do not want to worry about assignment or exercise, what does the investor do or try to do? Well, they might say, James, I want to go to bed tonight, sleep like a baby. Right click on those lines while holding the shift key down. Click on it, create closing order, and we're going to buy it back. Okay? Now, here's the thing. A lot of times people say to themselves is, the stock's at 568, I'm short at 560. There's no way it can go down. I want you to write those down, put that on your wall, and you're probably going to regret that you ever spat those words out of your mouth. Okay? I'm just repeating what a New Yorker said to me one day. He goes, James, I said that and that I spat those words out of my mouth, and I'll never consider if there's time remaining. Yes, it can go down. That's not being negative. That's being positive that the stock going down is a potential outcome. Okay? Create closing order, buy. Now, when he did say that, I kind of laughed because that was kind of a funny point. Now, 99 cents. Confirm send the order. So a pretty good learning lesson. Okay, so first off, 3 trades we talked about. Ford, we're still sitting there. We're not that far away from break even. 20 cents at expiration, but I need 60 cents to go up today to get to break even if we're talking about today. Why the difference? Time decay. When we talk about the Google example, okay, fine. That was the example where it went up. Meta is the example where the stock went down, but we're still able to walk away with gains. So this is why we kind of talk about the strategy. It's kind of interesting. Now, the real goal is, so what are you really trying to do? If the stock goes up, you're trying to make income, not stock ownership. You made money from the direction of the stock, sometime going by, and volatility. The stock goes sideways, you didn't make money from direction. You made money from volatility typically first, then time. And you probably did it for income. The third, if the stock actually goes down, you got the direction wrong, okay? It did get, and if the stock actually goes down, the second point is volatility, which we saw in Meta, and third is time decay. Just because the stock goes down, does that mean it's going to be a sign? No. But if it goes down further and further and further, then you might be in a situation like where you say, hey, James, I have a % of the max loss, like we do on Ford. Noted, okay? Now, any questions? Any questions? Okay? Now, there's a comment here just real quick. I'm just looking in the chat on what are 2 big ones here today they're announcing. Well, you got Apple, okay? What's the position? Just full disclosure. Now, I'm going to tell you, you follow my classes, it's not good enough to teach a strategy and say I did 1 trade or 2 trades. It's not enough, okay? It's like going to take tennis lessons and say the coach had me hit 1 or 2 balls and now I'm done, okay? Or golf. It's not enough. You got to probably practice 5 or 7 times a strategy and get used to the platform, the strategy, and then kind of have a feedback period of looking back, the entry, why you did the strategy, and so on, okay? Now, on that trade right there, this was also done on Monday, and that option, the short option is slightly down, which means the stock has gone down and volatility has maybe gone up, but we're short at the 230. This trade is really more of a cash secured put with downside protection. Why do we say that? Well, because it's not like a $5 wide strike with, it's not $10, it's $25. So, guys and gals, this is why we've been talking about it. If you're fearful over earnings, I don't care if you say it's been historically great. That could completely change overnight, okay? The moral of the story is if you don't want something where that risk is all the way down to 0, the investor might say, I'm willing to buy a put with a potential delta of 10 or less. Why a delta of 10 or less? It's way out of the money. And also the lower you pay, the less amount you pay for it, the bigger the net credit is. Okay. So just know the only example we did not do that on that I can remember is Ford. It's because the stock is $11. Now, one of the questions that was asked to me is, James, I saw these trades that were done Monday and Tuesday, but what fool? Why would someone actually, for example, do a trade where if you take one max loss, it would sedate or offset all the gains? The max loss on selling the put is if the stock went all the way to zero. Could Apple go to zero by expiration? It could. Statistical chances, not very high. But if you use that same logic, then the investor would never buy the stock either, because it could go to zero too. So it's like theoretically, yeah, it could go to zero, but what are the statistical odds that Apple and Amazon go to zero? I mean, zero. Okay. Now, could it? Yes. Did oil go to negative 47? Yes. Did it stay down there? No. Okay. So you just got to understand that. Now, if the investor says, I just don't like that, then the investor says, I'm probably going to be doing short put verticals. I'm probably going to be doing cash secured puts with downside protection. So let me just kind of tell you where these positions are. We're going to talk about new positions now. The Amazon, we sold the 182.5 for 330. It's at 430. Why did the put go up? Well, stock went down. Stock goes down, the put value goes up. Why is that? Well, because when we got it, the stock was higher. Now when the stock drops, the options don't cease trading because you got a position. They're still trading. The stock goes down, price up. Now, if we look at the position, down 98 cents. Now, I want to kind of show you the culmination of all these positions, which is kind of interesting. Okay? People don't really understand this, so let's hit this. When we look at our directional sensitivity, our deltas are 925. The biggest position that kind of has the greatest price risk is Ford, okay? However, when you look at the theta, okay, it's 431. So the biggest one that we really have is Amazon, okay? So if we have a theta so big like that, which is not normal, it probably tells us we're trading weekly option where we're on the cusp of either going boom or bust. What do you mean boom or bust? Well, if the stock is at 186 and we have a short strike at 182, if this stock closes above 182, we capture all of that premium, $330. And the investor can stuff that in their pockets and hold it if the stock closes above that strike price. We're saying closes. So the only way that theta is that big, it just means there's a lot on the line for the last day or 2 or 3 days. Okay. So now what is the paper money account going to do? It's going to play these out. Of course you want the stock to be above 230. Of course you want the stock to be above 182. Now, when we say that, you could say you're so hopeful, but the biggest thing is we did not over position size. Okay? If that stock were to be assigned, it's not too big of a position per the account size. And neither is this. We're not letting the premiums blind us to position sizing. Okay? All right. Other questions that you have? Okay? Yeah. Okay, now. Okay, man, lots of different types of questions. Now, I want to kind of go to just real quick a couple things that we see out there that are kind of interesting, okay? So number one is we see that when we take a look at, let's say, T-Mobile, okay? Now, I want to kind of talk about, let's say, just some stocks quickly, okay? T-Mobile getting a little bit of a pullback after the earnings, but its twin cousins, T-Mobile, okay, maybe trying to get a new little push to the upside with Verizon. Okay, now Verizon does not have the relative strength that T does. Right now, we're actually seeing AT&T kind of get a little bump. Now, with those new phones, okay, a lot of new maybe restarting the upgrade cycle, or if you have the older phone, people might want to reestablish a new contract. Keep an eye on those cell phone devices. Obviously, that's going to deal with Apple here today. Now, the other one I want to kind of just take a look at just real quick is when you look at Visa post the earnings, poked to a brand new high here today. Didn't close there, but it's still holding. Its other cousin, MasterCard, did not fare as well. So Visa holding up stronger, Capital One Financial stronger. American Express lagging a little bit. So in the card space, you're going to see that Capital One, Visa, and if you look at, let's say, Discover, those are the three cards that are really holding up better in terms of the financial space. Now, if we take a look at kind of what we talked about with what's happening with travel, one of the biggest earnings pops was Booking, okay? Big pop. And when you think about, let's say, something else in that space, like Expedia, not doing as well, dropping even some as well. But the one that I want to bring up before we look at our first trade, cruise lines, little pop for that one as well. But the first trade that we're going to do to try to mimic with what's happening perhaps with a Booking is Airbnb. Now, let's go back to that volatility theme. I said on Monday, what was the word of the week? What was the word of the week? Okay. Now, can anybody remember the word of the week? Earnings on this one coming up on the 7th. So we're talking about next week. Check me on that. Should be next week. Was it Thursday or so? The 7th? Next week. Now, when you take a look at this, there's been a slight upward trend here. Slight. Now, when we actually go down and look at the implied volatility down at the bottom, and if I were just going to kind of draw a range and kind of say, where's the lows? Maybe where's, let's say, most of the highs? Okay. Where do we get more touches? Probably right around 55. Okay. If I said kind of where's the middle of that range, I don't know. Probably somewhere right around 40, 45 or so. Okay. So when I look at implied volatility, I'm kind of like drawing it like support. He or she that gets the most touches potentially wins. Okay. And then he or she that draws the resistance at the most touches, okay, probably has an idea where that high end of volatility is. This was just a short-term spike going into the teeth of earnings, okay? Now, why are we bringing this up? Well, we're going to try to use this higher implied volatility again on a stock that has earnings next week, okay? Now, if we pull this up and looked at Airbnb, can we assume that the options are going to be liquid? No. 2 million on the stock. So we're thinking it's probably pretty decent on options, but we need to verify. Okay. So I can't do these ones because those expire tomorrow. Let's go down to the 8th November with 8 days remaining. Now, what I'm going to do is let's kind of open this up where we have 3 column headings. Okay. And we'll have delta. We'll put volume there. Okay. Now, by the way, you should always have these up so you have a real idea of where they really stand. So delta is very important. Volume, of course. Open interest, sure. Okay. And the fourth one, we'll just let that sit right there for right now. Now, if we were to go to, let's say, the next Friday. Now, wait, the earnings is on the 7th. If we do the 8th, this trade is only going to go for 1 day after earnings. Okay. Now, what we're going to show in this case is we're going to try to sell the put, and I'm going to choose a lower delta, okay? Now, if you look at that delta, it says negative 30. This is assuming that if you look at the call side, it's positive delta. You look at the put side, negative delta. Why? This table is assuming that you're buying, okay? You buy a call, positive delta, bullish position. You buy a put, negative delta, bearish position, bearish strategy. So if we flip that and say we're not going to buy it, we're going to sell it, well, that would be a positive delta, okay? Now, what we're going to do in this case is we're going to bring up all. We're going to go to this one, and just like we talked about before, how do you get good at something? You practice it, okay? Now, what we're going to do is we're going to sell the 128. Now, for the investor that said, James, I don't want to have unlimited downside risk, we're going to go look at a 116 put or lower that has a delta 10 or less. Now, when we look at, let's say, where do we kind of see more open interest? It's on the 115, okay? And that's going to be right there. Now, if you buy the 115, it's about 77 cents, and it's eating away some of that credit that you're receiving for the 128 call, okay? Now, what you're going to notice is if we look at this, so we're what's the obligation? We're short at the 128, less the credit, 252, and that gets us the break even, okay? Now, break even today? No. It's break even at expiration. Now, guys and gals, I'm going to tell you this right now. Not everyone should do options, okay? There's a lot of people that might not understand just basics, okay? Probably options are not for them. But people that actually can understand it are saying, look, what is this trade? It's the obligation to potentially buy the shares at the strike price. That option premium is affected by price movement, time, and volatility. This trade is really twofold reason. Number one is try to get income. The second reason is to try to get the implied volatility to drop. If you called a stock investor and said, how was your meta position? They might not even answer the phone today because it's down $22, $28 or whatever it was. But if you talk to someone who was a seller of that put, like our paper money account was in our example for educational purposes, it was positive. So that's what's kind of interesting when these different strategies are using, you're either going direction, time, or volatility. A stock investor is mainly going direction only. The only way they really make money from time might be a dividend, okay? Now, what we're going to do is we're going to send this order, and trade number one right there is on Airbnb. Now, I also want to go back to the other one. If we take a look at this, now, by the way, can you have a mixture of these strategies? Could you have a stock? Could you have stocks? Could you have ETFs? Could you have some option strategies that are focused on direction and some that are direction and time and some that are direction, time, and volatility? Sure. Some investors kind of think of it like playing golf. You don't just go out there with one driver, one strategy, and think you're going to just whale the ball with a driver the whole way around the course. Okay? Now, with that analogy, some investors just try to differentiate strategies so that way some of those strategies might do better in certain different circumstances, like a golf player. Okay? And so, and that way, if we kind of apply different strategies, and when the market goes up and down, we don't have to say, oh, my strategy is working really well, now it's horrible. Now it's working really well, now it's horrible. We're trying to smooth that out a little bit and try to have some different strategies. Now, speaking of one that had a little bit of a pop here, it was Altria, okay? Now, Altria, this is kind of interesting from the standpoint of, geez, quite a big pop here. And what you're now going to notice is if we go to the 3-year weekly, on a 3-year weekly chart, this really looks like it may be a longer term cup. Now, on the right-hand side, it might be trying to make the handle. Or in other words, we could say that as the flag. Now, what you're going to notice is its twin cousin, Philip Morris, has already gone to the upside, okay, had its flag, and it shot up first. Now, why do some people play these types of stocks, okay? Why don't people just do all technology stocks? Well, some people don't want to just play all technology stocks. They sometimes want to play stocks that maybe have some direction, but also some potential yield. I was wondering if you don't get direction. But the other thing is, if we look at, let's say, Altria, that yield is 7.48%, okay? Now, I used to think, well, dividends, who would do that? Well, the person who says that probably doesn't have that much money, okay? Because dividends, why they're always not going to guaranteed pay the dividend, They could raise it, they could cut it. It's going to vary based upon board policy, but also the financial condition of the company. Now, dividends are very interesting. They're a part of the total return, just like on the S&P historical returns. Do not poo-poo dividends, okay? Dividends are attracting different types of investors. And that's important because that everyone creates the market. It ain't just my perspective or your perspective. We like to have everyone, okay, who understands risk and is willing to take that risk. Now, on this, what you're going to notice is on such a big pop, this looks massive, but like when you look at a dollar amount, what you're going to notice is 51.40, and then we got about 54.49. Now, on this one, what we're going to try to do is just kind of try to do a buy limit order, okay? So that buy limit order is just saying, look, this is like being at an auction, or you go to a car dealership and you say, look, you want 20 grand for the car, I'm willing to buy for 19,500, okay? It doesn't mean they're going to accept your offer, but you put it out there. Now, what we're going to do is we're going to go to buy custom. We're going to go with stop. And on this, what we're going to do is say, look, we're trying to buy at this price or lower, and we're going to do it GTC. Now, many investors might say, James, I just don't want to always have that order sitting out there for the next couple of weeks or months. They might have, let's say, like in real estate, you make an offer and you might have an end date of when that offer might be valid to, okay? So it's not indefinite. Same thing goes here. We could say, look, this is valid for the next week or 2 weeks. If you go to that gear right there, you could specify if you want to cancel that offer, okay, to buy the shares at 53.51 or lower by a certain time. Simply go to that gear right there and you can see that. Now, what we're going to do is we're going to set that stop underneath that 51.54. Now, the one thing we got to understand is if you're an institution and you have a large position, the best time to get in or out of that position is on earnings. That is when the volume is the highest. And you got to understand something. You're going to see that sometimes what investors will do is they'll buy 2-3 months ago, and when the company comes out with earnings, and maybe it was even good, they might use the excess volume to sell their position. They're not saying the earnings was bad, but that earnings and the excess volume is their opportunity. The key word is to harvest those potential gains. Few investors really understand that, okay? We need to understand that because you can see so many times, but the earnings was good. You're an institution, you're trying to sell, the greatest chance to sell without impacting the price as much is on and or around earnings, okay? So always remember that. It ain't just what the earnings was, okay? It's do investors want to sell and maybe profit take? That doesn't mean they didn't get in weeks to 2-3 months earlier or whatever. Now, what we're going to do, last example, we're going to put a stop at 51.40, less 2%. We could go 3% here, but I'm going to go ahead and put 50.37. Now, I want to give you a homework assignment. This week, I think we did 8 earnings examples. We got 2 main ones coming up today, Apple and Amazon. What do you think your homework is? Well, I think the homework would be for you to find out what stocks are coming up with earnings next week. Okay, number 1. Number 2, are there any of those stocks where they might be trading at the 80th percentile on the IV? Can you practice yourself in paper money and try to do those trades just like we did this week? And I'd like you to practice in third, practice maybe a weekly option, practice a monthly option. Can you understand why that position is gaining and or losing? That's what I want you to do for homework, okay? So what stocks are coming up with earnings next week? Are any of those stocks at the 80th percentile or higher? And third, practice them on a weekly and a monthly perspective in terms of the expiration. That's what I want you to do for homework. Now, we'll come back on Monday and we'll actually talk about how do those Apple positions and Amazon work. We did 2 new trades here today, Airbnb, and we also chose Bo as well. Now, I'm out of my time here today, but I want to kind of make mention to you. You can subscribe to the Trader Talks channel, okay? And also a quick reminder there, it's a free subscription. It's just allowing you to follow the content, see all of our information as well. We also have a playlist for this class as well. There's the playlist. Follow Mike and myself actually on X. All of us coaches post there, so stay tuned for that as well. And remember, with what we discussed here today, it was done for example illustrative purposes only. Great discussion on the past week examples, and we got 2 main ones left, okay? So remember, with what we talked about, all investing has risk. And with that, we want to be mindful of that, especially in terms of position sizing, and be aware of what's impacting the prices. With that said, this has been the class on trading the trend and volatility. And with that said, thank you so much. Take care. Bye-bye.